Buying your first home is exciting. It's a big decision. You need the right loan. A bad loan can cost you. It can even lead to foreclosure. The right loan makes payments easier. It helps you build equity faster. It gives you peace of mind. Take your time, shop around, compare offers. It's worth it. This guide will help you find the right loan. We'll explain different loan types. We'll discuss interest rates and fees. We'll show you how to avoid common mistakes. Let's get started on your path to homeownership. Before you look at loans, it's crucial to check your finances thoroughly. Start by knowing your credit score. This number is a key indicator of your financial health and will significantly impact the loan rates you are offered. A higher credit score can open doors to better interest rates and more favorable loan terms. It can save you thousands of dollars over the life of your loan. Next, check your debt-to-income ratio, or DTI. This ratio compares your monthly debt payments to your gross monthly income. Lenders use this ratio to assess your ability to repay the loan. A lower DTI indicates that you have a good balance between debt and income, making you a more attractive borrower. To calculate your DTI, add up all your monthly debt payments, including credit cards, car loans, and any other recurring debt. Then, divide that total by your gross monthly income. This will give you a percentage that represents your DTI. A lower DTI is better for loan approval. Aim for a DTI of 36% or lower to increase your chances of getting approved for a loan with favorable terms. Additionally, save for a down payment. The more you can put down upfront, the smaller your loan will be. A larger down payment not only reduces the amount you need to borrow, but also lowers your monthly payments and can even help you secure a better interest rate. Lower monthly payments mean less financial strain and more room in your budget for other expenses or savings. Don't forget about closing costs. These are additional expenses that you will need to pay when finalizing your loan. Closing costs can include fees for appraisals, inspections, and legal services. Make sure to budget for these expenses to avoid any surprises. Knowing your finances inside and out helps you qualify for the best loans available. It gives you the confidence and knowledge to negotiate better terms. Understanding your financial situation puts you in a strong position as a buyer, allowing you to make informed decisions and secure the home of your dreams. There are many types of loans available for first-time homebuyers, each designed to meet different financial needs and situations. Each loan type has its own set of pros and cons. Understanding these differences is crucial to making an informed decision that best suits your financial situation and long-term goals. Let's break down the most common options available to you as a first-time homebuyer, so you can navigate this important decision with confidence and clarity. Fixed-rate mortgages. These loans have the same interest rate for the entire term, providing stability and predictability in your monthly payments. This can be particularly beneficial if you plan to stay in your home for a long time. Adjustable rate mortgages, or ARMs. These loans have interest rates that change periodically, which can result in lower initial payments. However, the rates can increase over time, which might lead to higher payments in the future. FHA loans. These are insured by the Federal Housing Administration. They often have lower down payment requirements and are easier to qualify for, making them a popular choice for first-time homebuyers with limited savings. VA loans. These are guaranteed by the Department of Veterans Affairs. They are available to eligible veterans, active duty military, and surviving spouses. VA loans often come with favorable terms such as no down payment and no private mortgage insurance. USDA loans. These are offered by the United States Department of Agriculture. They are designed for homes in rural areas and often come with benefits like no down payment and lower interest rates, making homeownership more accessible in less populated regions. Each loan type serves different needs and can be more or less suitable depending on your personal circumstances, such as your income, credit score, and how long you plan to stay in the home. We'll explore each of these loan types in detail in the following sections, providing you with the information you need to make the best choice for your new home. Fixed-rate mortgages are popular. They offer stability. Your interest rate stays the same, so do your monthly principal and interest payments. This makes budgeting easy. You know what to expect each month. Fixed-rate mortgages are good for long-term stability. They protect you from rising interest rates. If rates go up, yours stays the same. This gives you peace of mind. However, if rates go down, you miss out on lower payments. You can always refinance later, but that comes with costs. Section 5. Adjustable rate mortgages, or ARMs navigating fluctuations. ARMs have interest rates that change. They start with a fixed period, usually 3, 5, 7, or 10 years. After that, the rate adjusts periodically. The initial rate is usually lower than fixed-rate mortgages. This can make your payments lower at the start. ARMs are good if you plan to move soon. However, ARMs come with risks. If interest rates rise, your payments could increase significantly. This can make budgeting difficult. ARMs are complex. Make sure you understand how they work before you commit. Section 6. Government-backed loans, FHA, Virginia, and USDA. Government-backed loans help make homeownership accessible. They are insured or guaranteed by government agencies. FHA loans require lower down payments. This makes them great for first-time buyers. VA loans offer favorable terms to veterans and military families. They often require no down payment. USDA loans support rural development. They offer zero down payment options to eligible borrowers. These loans have specific requirements. Check your eligibility before applying. They can be a great option for qualified borrowers. Section 7. Comparing loan offers, interest rates, terms, and fees. This section is crucial for understanding the true cost of your loan and making an informed decision. Once you know your loan options, get quotes from multiple lenders. Compare their offers carefully. This step can help you identify the best deal and avoid unnecessary costs. Pay attention to these key factors. Interest rate, which is the cost of borrowing money. The interest rate directly affects your monthly payments and the total amount you will repay over the life of the loan. A lower rate means lower monthly payments. Even a small difference in the interest rate can significantly impact your budget and savings. Loan term, which is the length of the loan. The term can range from a few years to several decades depending on the type of loan and your financial goals. Shorter terms mean higher monthly payments but less overall interest paid. This option is ideal if you can afford the higher payments and want to save on interest. Longer terms have lower monthly payments but more interest paid over time. This can be beneficial if you need lower monthly payments to manage your budget. Fees, as lenders charge various fees. These fees can add up quickly and increase the overall cost of your loan. These can include origination fees, appraisal fees, and closing costs. It's important to understand each fee and how it affects your loan. Don't be afraid to negotiate. Lenders may be willing to reduce or waive certain fees to earn your business. Ask lenders for their best rates and terms. Being proactive and asking questions can lead to better offers and savings. A small difference in interest rate can save you thousands over the life of the loan. By carefully comparing and negotiating, you can secure the best possible deal and achieve your financial goals. Section 8. Navigating closing costs and additional expenses. Closing costs are expenses you pay when you finalize your mortgage. These costs are separate from your down payment. They can include loan origination fees, appraisal fees, title insurance, and home inspection fees. Closing costs can add up, so be prepared for these expenses. Ask your lender for an estimate of your closing costs up front and factor these costs into your budget. Section 9. Avoiding common first-time homebuyer loan mistakes. Buying a home is a big step, and it's easy to make mistakes. Here are some common ones to avoid. Not shopping around for the best rates. Get quotes from multiple lenders. Not understanding the loan terms. Read the fine print and ask questions. Taking on more debt than you can afford. Be realistic about your budget. Skipping the home inspection. This can save you from costly repairs later. By avoiding these mistakes, you can make the home buying process smoother. You can also save yourself time, money, and stress. Section 10. Seeking professional guidance, real estate agents, and loan officers. You don't have to navigate the home buying process alone. Real estate agents and loan officers can help. Real estate agents help you find homes, negotiate offers, and guide you through the process. Loan officers help you secure the best mortgage for your needs. Choose experienced professionals and ask for referrals from friends or family. A good team can make all the difference. Section 11. Making informed decisions, your path to homeownership. Buying your first home is a journey. It requires careful planning and research. By understanding your finances, exploring loan options, and comparing offers, you can make informed decisions. Don't be afraid to ask questions and seek professional guidance when needed. Remember, the right loan can help you achieve your homeownership dreams. Congratulations on taking this exciting step. With the right knowledge and preparation, you'll be well on your way to owning your dream home.